So what's this? 500 points in 2 days from 28,000, 2% or so.
Yeah, I mean,
beginning of anything.
Not a huge deal when you think about a year when markets are up 25+%.
It's only the third.
Yeah, but
things can happen in December. We saw last year.
We certainly saw that last year. I think the difference now is the direction of policy is much more supportive on the monetary side than it was last year, and that's what got people.
People talk about that. I always wonder whether that you buy that Santoli that it wasn't trade. It was the Fed really did do a couple of hikes that they shouldn't have done, or at least one.
Well, I think it was a confluence of all of it. I do think that the economic momentum was being lost faster than the Fed was giving it credit for, so they did squeeze in that December rate hike last year. But also, we were just in kind of a liquidation mode. When you have a situation where you're going from 20% annualized earnings growth down to something close to zero, which was the situation a year ago, the market isn't really well set up to handle that, I think, on the fly. So I think, yeah, obviously the Fed getting tighter in that moment was not necessarily a helpful thing. I don't think last December has a whole lot of bearing on here, just because the field position is totally different, not just the Fed. Obviously, we now have a kind of overstretched market to the upside that all it's doing is shaking out, maybe testing the basis for this last little extension of the rally. I don't think we've necessarily really compromised anything about the trend that got us here, except a lot of people thought, just taking it as a given, that we were going to have no tariffs on December 15th and that the manufacturing economy was bottoming and was going to gain some pace. Those things right now are just slightly more in doubt. In December, you always have a tension among tactical investors between let it ride and lock it in. Well, and so we were letting it ride. Maybe we're locking it in now.
We don't have that much time before the end of the year, Parker.
Yeah.
Then we got China won't be fixed probably, obviously, and an election. So what about next year? What's going to dictate what happens in January and February, which are important for the rest of the year, right?
Clearly, that's what's going to dominate the headlines, but I think the reality, what we're going to be looking at is really the fundamentals. And the positive news is you look yesterday, global manufacturing PMIs improved for the fourth month in a row, ticked back above 50. What you have to remember, monetary policy works on a lag. It takes 9 to 12 months for that to really impact the economy. The pain that we felt at the start of this year was a result of a lot of the tightening last year, plus trade. Now we've seen significant shifts from the Fed, but also central banks around the world. That's starting to feed through positively into the fundamental narrative. You're going to need to see corporate earnings. We've seen a lot of the rally this year come from valuations moving higher. I think that's pretty much done. Now we need to see the earnings story come through. That's what's going to decide what markets do in 2020.